Hello, everyone, and welcome to our first Taxes 101 webinar. Excited to get things kicked off with you all today. I would love to hear where you all are tuning in from. As you'll see, we have John Parrott, our Investor Relations Manager in chat, tuning in from Whitefish, Montana. I myself am tuning in from Seattle. Oh, wow, we got New Jersey, Massachusetts, California, Fair Oaks. Love to see it. What do we have? LA, Chicago, North Carolina. Ooh, Nashville. Love to see it. It's finally starting to feel like fall in Seattle today, so I'm ready for all the pumpkin spice lattes and leaves to fall. We've got some great content ready for you all with awesome special guests today to walk through everything Taxes 101. So we'll give it 30 more seconds here. We have a whole host of folks on the line today. It's looking like coast to coast. And I know our team's excited to walk through all the details today around taxes. Atlanta, Georgia, Stafford County, Washington. Love to see it. Ooh, white salmon, Jake. Very cool. I'm in Bonnie Lake, Washington, so I always say Seattle. Kansas, all over the map today. Knoxville, Tennessee. Welcome, Cynthia. Wonderful. Well, for everybody on the line, we're so thrilled to have you here today. Again, this is our Taxes 101 webinar we have some incredible special guests. So we will hop right to it. For everybody on the line, this is recorded, so you will receive a recording post-webinar via email. If there's any surrounding questions that we can help you with at the end, the best way is to reach us is support@arrivedhomes.com. I would love to introduce our speakers today. First and foremost, we will start with Joel Mezistrano, our Chief Financial Officer, who's served with Arrived since inception. Pretty incredible. For the last 10 years, Joel has been a principal and CFO at American Classic Homes, which is pretty wild. It has an annual revenue in excess of $100 million and operates several investment funds utilizing institutional capital, family offices, and high net worth individuals. Joel is also a principal and CFO at C-Level Properties, which has $250 million portfolio of apartments and mixed-use projects in the Seattle area. So we are definitely grateful to have Joel leading the charge on our team. We also have Jake P., who you've met before, our operations manager. Jake will be coming on here shortly and also interacting in the chat with you all. And then again, my name is Corinne Headland, and I lead our investor relations team here at Arrived. You probably saw too, we have John Parrott, our investor relations manager. He will be answering questions in the chat and then also queuing them up behind the scenes so we can answer those at the end of our prepared remarks. A quick disclosure that I wanted to run through, this does not serve as a research report or investment advice. We obviously walk through all the details regarding taxes, but we always recommend that you consult with your tax advisor just to make sure you're in line with your financial goals, and so on and so forth. So you will receive a copy of this after, but just wanted to share this quick disclosure before we got started. In terms of an agenda, I would love to set the stage for you all. So first, we will walk through legal structure, a brief taxes overview, rental income and capital gains, long-term and vacation rentals, more of like the differences here, and then taxes 201 and 301. And this is where Joel will essentially be going through the differences and in more granular details for those that are interested. And then, as I mentioned, we will be doing live Q&A at the end, which means any questions that typically elicit a little bit more color, we like to answer those live with our team ready in action. So Jake, would love to have you hop up on stage here to walk through the Arrived legal structure.
Awesome. Excited to be here.
Definitely.
So before we get too deep into the taxes, I want to do a brief overview on the legal structure of Arrived Investments. So when you buy shares of an Arrived property, what you're really buying is shares of a limited liability company. And that LLC is what owns direct title to the property. Now, the LLC is the legal structure. And in our case, those LLCs elect to be taxed as C corporations in the event of the vacation rentals. and they meet all the qualifications to be taxed as a real estate investment trust, a REIT, for the long-term rentals. We'll get into the details of how those differ later on, but the important thing to know for now is that for investors, Arrive will issue a consolidated 1099 DIV each year. It's a really easy tax form that makes it simple to do your tax filings. It's a lot easier than a K1, which some of you may be familiar with from other real estate investments or syndications. So now on to the taxes. Of course, anytime that you earn income, you need to report it to the IRS and pay taxes on it. And the tricky part that comes with taxes is that different types are taxed different ways with different limitations and at different rates. So as a brief overview of how you make money in real estate, we'll go through the rental income, which is earned each year as the property is operating, renting it out to a tenant and distributing dividends, and then the capital gains, which come at the end of the investment period when there's a sale. So to hone in on the rental income component first, investors pay taxes on the profits of rental property, not on the dividends they receive. So here's an example of how we would calculate those profits. You basically take your revenue, which in our case is rent, and you subtract all of the expenses related to the property, and that bottom line profit is what is taxable. Now, what you'll notice here is that we collect rent from a tenant, and that is dollars that sits in the LLC's bank account, and then we use that money to pay out all the expenses. So from the rent that's collected, we take some money, we pay out the insurance premiums, we pay for the property taxes, the interest, and then what's left over is the profit. Now, what's really interesting is you'll notice this line item at the very bottom called depreciation. Depreciation is basically a non-cash expense. So it's essentially an additional deduction you're allowed to take just for owning real assets. So even though we've collected rent and we're paying out all of these other expenses, there is no depreciation bill. There's no one that we actually pay money to for depreciation, but you get to write it off as an additional expense. So that means that it lowers your profit, which therefore means lower taxable income and lower taxes that you need to pay, even though you still have the same amount of dollars in the bank account. So let's go through an example here of what that looks like in practice. Here's my personal Arrived 1099 DIV tax form from last year. So I started investing halfway through the year and I got a couple of dividends toward the end of the year. And in total, I had $58 that was deposited from my Arrived properties into my bank account. Of that $58, you can see in box 1A up there, the top middle, only $3 of it was actually taxable profit. The rest, $55, is about in the middle there, that box 3 that says non-dividend distributions. So essentially, I invested in a bunch of properties that either had no profit from an accounting point of view or a very small profit, which is how I was able to get $58 in dividends in cash flow generated from those properties, but only have $3 of it be taxable. This is a huge reason that investors love real estate, because you can generate cash flow from the properties, but limit your taxable income because of depreciation and other favorable real estate deductions. Now, the other way that you make money in real estate is from the capital gains. Now, capital gains is basically when you sell an asset for more than you paid for it. And here's the technical definition of a capital gain, because there's some accounting nuances, but it's basically the idea of buying low and selling high and then making money on that difference. Now, this will happen at the end of the Arrived investment period. We're aiming to hold our long-term rentals for 5 to 7 years and our vacation rentals for 5 to 15 years. And so hopefully the market will appreciate over the next few years and we'll be able to sell the properties for a lot more than we paid for them. Typically, those capital gains are taxed at lower rates than the rental income, and that's true for the Arrived long-term rental properties, but not for the short-term rental properties. And that's actually a good time to bring on Joel, who's going to talk about the differences and the nuances between taxation on those long-term properties and those short-term properties.
All right, thank you very much, Jake. Great to be here. Let us go to the next slide. All right, so we have created at Arrived what we believe are the world's smallest REITs. Traditionally, REITs have been these massive, office building portfolios and commercial portfolios, apartment buildings, et cetera. We have created REITs out of single homes, and we're doing dozens of them every month. And as we talked about, REITs are a special kind of corporation. They're the only type of corporation that has a few privileges based on the IRS rules. So the first thing just want to point out is that rental income is passed through as an ordinary dividend. And that tax rate ends up being the same even if you own the property directly or if you owned it through an LLC. It all ends up being at your marginal tax rate, which is how ordinary dividends are taxed. Now, again, the most important thing about a REIT is that it passes through capital gains to investors. And again, it's the only type of corporation that can do this. And capital gains have a much lower rate than your ordinary income rates. Now, there's a special tax law that's in place right now. It started in 2017. It was called the Tax Cuts and Jobs Act. And the IRS gave basically a 20% discount on all dividends that come from REITs. And there were a bunch of other incentives for other businesses as well. And it's typical for the IRS sometimes or Congress to create a set of tax laws that is only in place for a certain amount of time. But we're very fortunate because we've still got a few more years left. So any taxable dividends that we do have from our REITs get a 20% discount when it gets reported on your own tax returns. So we got to just take advantage of it as long as we can. Lastly, as Jake mentioned, one of the really great things about being a REIT and corporation is we get to use a 1099 dividend, which is, again, a very simplified tax form compared to a K-1. All right, so now we're just going to talk about vacation rentals. So vacation rentals are a little bit different. So the first thing I want to point out is that, again, they are not a REIT. And the reason they're not a REIT is because, the IRS, and they came up with the rules for a REIT. It's meant to be passive income from real estate. And because the leases, short-term rental stays are less than 30 days, they don't actually qualify as rental income, according to, again, just this IRS definition. The other reason, and it's the same reason why hotels can't be REITs, is you're not just purely renting out the property, you're also providing a bunch of services that go along with it. You may be doing cleaning, you may be providing utilities, you may be restocking the soap, providing a welcome basket, things like that. Those things go above and beyond just renting out the property. So for those reasons, they do not count as REITs. So we talked about dividends from operating the property, and we talked about getting capital gains when the property is sold. Let's take the dividends first. So when we operate our properties, because we have depreciation, we're wiping out a lot of the income that we would get. So our cash flow is much higher than the amount of taxable profit. So as a result, we're not passing on a lot of income to investors while we're operating the properties. Now, REITs do not have to pay any state taxes. That's one of the other special things about them. Corporations, which our short-term rentals they do have to pay state taxes. Now, here's the good news. Most states have a pretty high income threshold for when you have to file a tax return and pay taxes. And in the vast majority of the cases, especially because so much of our income is wiped out by depreciation, we are below the threshold. So even though in theory we might have state taxes due, in practice, that very little actually happens. Now, there's another thing about corporations that, some people may have heard the term that they're subject to double taxation. And that means that some of the tax is actually paid by the corporation itself, and some of the tax is paid by the investors that own the corporation. And when REITs, we pass income as ordinary dividends. In short-term rentals, we're actually passing them as qualified dividends, which get taxed as a lower rate. And the way the IRS designed the system, if you add the tax rate the company pays and you add the qualified dividend rate, it actually turns out to be the exact same rate that you would pay otherwise. So as a result, everyone is paying the same rate. It's just that some of the tax is split between the corporation paying some and the investor paying some. So we're not actually penalized for the double taxation structure of a corporation. The one time we will have to pay some state tax is hopefully we will have a capital gain years down the road when we're selling the property. And in that case, we may be over the filing threshold in some states, and there may be some state tax due. But again, during that 5 to 15 years that we're operating the property, there should be very little of it. All right, so now we're just going to talk about a couple different topics that come up frequently. I'm just going to touch on them briefly, and we can take some more questions about them later. But the first is 1031 exchanges. And the trick with 1031 exchanges, there's a couple rules that you have to follow. The first is whoever is the taxpayer, whoever is actually on the title of the property, has to be the exact same before and after. So if one person, 2 people, 5 people are on title before, that exact same 5 people has to be on title after. If you own it through an LLC before, you have to have the same LLC be on title after. And because we have a REIT structure and we have shares of LLCs we created, a 1031 exchange is just not possible. The other reason is that the IRS rules, they say the exchange has to be, it's called like kind. So it has to be the same nature of investment before and after. And the IRS doesn't consider shares of a REIT to be like kind. So again, for those 2 reasons, 1031 exchanges aren't possible with REIT structures. Another thing that comes up from time to time is people ask about international. And that could mean people from outside the US investing in our REITs and short-term rentals, or it could mean us buying properties in countries other than the United States. And the short answer is we're working on both items. They just take some time. There's a lot of compliance involved, especially with international investors buying US real estate. There's a lot of laws, and actually the compliance costs are very high. So it's something that we're working on, and we hope to offer that in the future, but not today. And likewise with international properties, we really love the opportunities that are available in the United States. The United States has been one of the best places to buy real estate throughout the history of time. And there's still an amazing number of opportunities in front of us. So we're still excited about that. But in the future, I think at some point we will add some international properties to our portfolios. On a different topic, people like to invest their IRAs, which is a great way given that they're tax exempt, and a lot of people have already saved up some money in their IRAs. There's a lot, I know we've talked about a lot of complicated rules all throughout this presentation, and that is the nature of our tax laws. IRAs have some complicated rules themselves, and they don't allow you to invest in an investment that uses debt. It triggers this extra kind of tax. But fortunately, our long-term rentals, which are REITs, this does not apply. So even though a lot of our REITs use leverage and we have loans on the property, we can still allow IRA investors to buy those properties. So that's great news. The last thing is just people ask about tax losses and how that might offset other income. Well, when we have losses in our REITs and in our corporations, we could actually carry them forward to future years. So we could offset operating income or even capital gains in the future. So we will be able to take advantage of those losses. It'll be deferred into the future. The way corporations and REITs work, you're not allowed to pass losses onto investors and take them in that current year. And there's a lot of rules, even if we could, there's a lot of very complicated rules around whether people are allowed to do that, especially on passive income and passive investments like we have here at Arrived. One other topic to bring up before we move to Q&A, and that is what happens when we sell the property. So say we buy a property, let's just use a simple example. We buy it for $100,000 and we sell it for $150,000, but we've taken $20,000 of depreciation over the life of the investment. So that's great news. The $20,000 in depreciation, we've been able to pass through to investors as tax-free cash flow. And the $50,000 in capital gains is very, tax-friendly, and it's not paid until we actually sell the property. So what happens here is that we're going to divide the $50,000 and the $20,000. That's going to be two separate buckets. The $50,000 is going to be a pure capital gain, and it's going to be on a specific box of your 1099 div form. The $20,000 that we depreciated every year throughout the life of the property, that is passed through. It's called a depreciation recapture rate, and it's got a slightly higher rate than the top capital gains rate. So it's taxed at 25%. Now, while we're operating the property all those years, we're actually getting the benefit of the cash flow, and we're reducing our ordinary dividends at a much higher rate. So not only are we getting a rate advantage by depreciating the property over the years, we're also deferring the time we have to pay that back till many years down the road. So we end up winning on this one as well. So now I think we're going to move to Q&A.
Wonderful. Joel and Jake, thank you so much for your prepared remarks and walking through all things taxes. I'm going to go ahead and remove these slides really quick. And I see a whole host of questions in an active chat, so I'm excited to get started. As Jake mentioned in that chat, feel free to have them coming through. We're taking them behind the scenes and teeing them up for both Joel and Jake to answer. If there are any more of Arrived 101 questions, those are better suited for our Tuesday, Friday webinar that we hold at 9 a.m. PDT tomorrow and 1 p.m. PDT on Friday. And then we also have support at arrivedhomes.com for any clarifying questions as well. So Jake and Joel, are you all ready to get started with some questions?
Let's do it.
Awesome. Joel, I'm going to kick this first one over to you. We have some frequently asked questions that I think are great to set the stage with. So if I owned Arrived properties in different states, will I have to file a myriad of different state tax returns?
No, thankfully, no. That is one of the best things about it, is that this is one of the privileges of being a REIT. So REITs do not get, when you have a property through a partnership or you own it directly, you'll get a K1. And if you have income from a property in another state, you may have to file in that other state. With REITs, we just pass the dividends to you, and you pay taxes based on the state where you live and file your taxes. It has nothing to do with where the properties are.
Which is so great.
Yes.
Consolidated 1099, right? It's like less is more when it comes to tax season, Joel and Jake, as you both know. And two, Joel, will those be consolidated with asset classes as well? So long-term versus vacation rental?
Yeah, so we do have the ability to report short-term and long-term on the same tax form because they're both 1099 divs.
Amazing. Wonderful. Consolidation station. We're here for it. Jake, the next one is for you. When will Arrived have tax forms ready?
Yeah, so we'll have tax forms ready and available in your Arrived account by January 31st each year for you to be able to file your taxes in April. And what's really nice is that we'll issue that consolidated 1099 that has everything aggregated together for filing. And then for informational purposes, we also have a supplemental doc we'll give you that shows you the actual amount of income that came from each property and how much was taxable. So you can see the breakouts. Not really anything that you need to do with that, just more for informational purposes, but we'll have that ready for you in January for any dividends you receive in 2022.
Wonderful. And Jake, for those documents, like I would imagine we have some newer folks that haven't hit tax season from the previous year. Where can you typically find those within your account? It'll
just be within your Arrived account settings. There's a little section for documents, and then there's a little subsection for tax stuff. And we'll send out an email to everybody when those documents are ready, so you don't need to be checking it every day in January.
Perfect. And you mentioned dividends, which is obviously a hot topic. When do you foresee, can you first talk through the months in which you receive a dividend, and then perhaps when you can expect Q3 dividends?
Yeah, so we pay out the dividends quarterly right now. And so since we just wrapped up Q3 on September 30th, we'll be paying out our Q3 dividends at the end of October. And then after that, the next payment for Q4 is going to be in January. And what's kind of cool about that is because you'll be paid out in January, that income will be earned in 2023. So you actually won't need to pay taxes on it until you're filing in spring of 2024. So there's a little bit of a tax advantage for investors to be kind of getting that dividend early in the year because you have longer before you really need to file your taxes.
Wonderful. And I did see there was one other one in here, Jake, that I'll kick to you before Joel. What if there isn't appreciation when Arrived sells the property?
Yeah. So if, in the event that we were to sell a property for a loss, that loss would kind of pull through to the investors. So, instead of a capital gain, you would have a capital loss, which would then get, pull through onto your tax return. From an operational perspective, we aim to not have capital losses. We aim to basically continue to operate the properties. And since you're making money two different ways, you can still be collecting that rental income. And so if we get to the end of that, 5 to 7 year period for the long-term rentals, and it looks like we would have to sell the property for less than we paid for it, we'd most likely just continue to operate the property as a rental and kind of wait for values to recover because we have kind of control over that final sale time. So while we're aiming for that, 5 to 7 years for the long-term rentals and 5 to 15 years for the vacation rentals, it kind of depends on the market, and we'll be opportunistic as the manager to see, what we can do to maximize investor returns.
Wonderful. Yeah, thanks for walking through it. It's a great question. I did see another one flow in here that, Joel, I'm going to kick over to you. And I will say this depends on obviously long-term versus vacation rentals, but are the dividends ordinary or qualified?
Right. So for our long-term rentals, they are ordinary dividends. And for our short-term rentals, they are qualified dividends.
Perfect. Wonderful. And I saw one in here from Christy. They mentioned my husband has a small biz. He files as a sole prop. I file jointly with my husband. How do I report arrived income? Joel, if you can walk through that one.
Sure. So as Jake mentioned, we have our 1099s that we distribute to all investors, and the 1099 is just simply entered onto your tax form. So if you are married and you're filing jointly, then you file a joint tax return. So it would all go on the same tax return.
Wonderful. Yeah, Christy, let us know if there's any clarifying questions in there. Pretty straightforward, but happy to walk through it further. I did see a few we've had behind the scenes around refinancing. So I'm going to throw this one to you, Jake. Could you refinance the properties and do a tax-free distribution?
So like where your head is at, it's definitely something we could do in the future. The thing that would limit us from doing that right now is really just our SEC documents and our disclosures and our filings, because we haven't kind of written that language in. But for future offerings, I think that's something that we could consider. And for those who aren't sure what we're talking about, when you refinance a property and you add more debt to it or add a new loan to it, you can actually take that money out of the property and it's tax-free because it isn't a dividend, it's not a sale, it's a refinancing, and you still owe that money back. So let's say that, we've got a bunch of these properties that have, 6% interest rates right now because the mortgage market has been so crazy the last couple of months. Down the road, if rates were to drop back down to 3 or 4%, you could refinance that, basically take out a loan to pay off the 6% loan and keep a new loan at the property at, that 3 or 4% rate. Not something that we are set up for right now, but something that if we change our SEC documents, our disclosures, and some of our operating procedures, certainly something that we could do. There really isn't anything else that's preventing us from doing that. And it can really be a great tax strategy, particularly on those vacation rentals, because they have up to a 15-year lifetime.
Wonderful. Yeah. Thanks for walking through that one, Jake. I did see another one in here from Jason. Can you use a self-directed IRA as a course of funds? Jake, I'll throw that one to you.
Mm-hmm.
Yeah, so IRAs are interesting. Usually the rule is that within an IRA account, you can invest in different investments. And if you have what's called a self-directed IRA, you can invest in things beyond stocks and bonds. So you can create this kind of self-directed investment fund, and that allows you to go out and say, buy a piece of real estate and own a rental property within your IRA. Now, usually you're not allowed to use debt investments within the IRA without tax penalties. You can make those investments, but there may be additional taxes due. And part of the benefit of investing with your IRA is to avoid those taxes. The good news is that REITs are exempted from that. So if you wanted to, you can invest with your self-directed IRA into Arrived long-term rental properties because they're all taxed as REITs. And that allows you to get exposure to a debt investment or an investment that has debt on it and not have to deal with any of those tax consequences. Now, since you can't invest, since the vacation rentals on Arrive are not taxed as REITs, we've kind of prevented the IRAs from investing in them just so that investors don't get hit with any unforeseen or unwanted tax consequences. But it's a really cool thing that you can actually take your money and invest it into a leveraged investment and not have to deal with those tax penalties as a benefit because of the way that the investments are structured.
Definitely. It's a great call out too, Jake, on not being able to invest if you do have a IRA set up. One alternative there is to create a second account. So you're more than welcome to create an additional one if for whatever reason you created your initial one under that IRA. So it's definitely an option if vacation rentals are an asset class that you desire to invest in. I saw another one here from Shanakara, or I pronounced that wrong, Shanakra. If I am so sorry, phonetically, that's very off. Keep me honest in the chat. As a fractional owner of the properties, can I avail the same business deductions if I visit the properties? Joel, I'm going to kick that one over to you.
Yeah, unfortunately not. This is all the Arrived investments are passive investments, which means our investors are not actively involved in managing the properties. And so you wouldn't be able to do a write-off like that. If someone is a professional investor and that's what they do for a living and they just manage all sorts of investments, it may be possible, but the deductions of these type of expenses are very difficult and very nuanced. But just as a general, I didn't want to say categorically no, but it's for almost every one of our investors out there, the answer is going to be no. It's not quite so simple.
Yeah, it's a great question. Let us know if there's further clarification in the chat. We're here for it. I did see one flow in from Brandon. And Joel, I'm going to kick this one over to you. I'm curious about California investors and how any of this can be focused on that population. Also, short-term rental taxes. I'm curious if you invest in Arrived STRs, and then you need, since they are not a REIT.
Right. So that's a great question. I touched on it earlier, but to clarify that, I mentioned that there may be some state taxes due because we are a corporation and not a REIT when we're a short-term rental. The good news is any of the taxes due are going to be filed by us. So it's our corporation that files the taxes, not anything any of our investors would have to do. So if we had investors from all 50 states buy a short-term rental in California, there wouldn't be any requirement to do anything in California. You would just get that 1099 and you would put it on your own personal tax return, and whatever state you're in, then it would just be taxed like any other dividend that you got from even Microsoft or IBM. They're all taxed the same way.
Wonderful. Yeah, great question, Brandon. Thanks for walking through it, Joel. I did see a few questions flowing in here from multiple people around the point of sale and who determines that. So this one is from Dan. Given that our shares are essentially membership interests in the LLCs, please shed some light on the voting rights associated with the shares. Specifically, I'm curious about how, when the sale of the property is determined. So Jake, I'm going to kick this one over to you.
That's a great question, Dan, and probably something I should have added to that legal slide at the beginning. So when investors fund a property, investors own 100% of the membership interests in that LLC, but Arrived, our corporate entity, is the manager of that LLC. So basically all of the owners of that LLC are silent partners, and our job is then to manage it. So as a result, there isn't really any, voting rights or control that the investors have. We may take proxy votes, or we may take, kind of informational surveys to kind of see what people want to do. But at the end of the day, our job is to manage the LLCs. So we decide, who to rent the property to, what rent to set it at, when to sell the property, what improvements to do. And we really have kind of full control as kind of outlined in our documents. That said, we may ask for informational votes just to kind of, we want to do what the investors want. But even if we were to do some kind of a vote like that, there's no formal, binding or anything like that. It's just kind of the way that everything is set up and structured, because we've got a lot of investors, and it would be really hectic to try to get, 800 plus investors to agree on what to do for every single thing related to the property.
Yeah, thanks for walking through it. Prem, I believe you had a similar question along the lines here. about voting rights. So let me know if there's any further clarification. We can definitely answer that one live as well. Jake, you already have color to add.
Yeah, I can jump in there. I just saw Prem's question about liquidity as well. So related to that, yes, Arrive has control over when we sell the property, but we're going to be launching a redemption program very soon. And so that'll be a way where investors will have a quarterly option to sell their shares back to Arrive and capture any of the appreciation that's happened so far. So that way, even though we're holding the property for, say, 7 years, you may invest, hold it for a couple of years, and then opt to sell your shares after 3 or 4 years. Everything else will function pretty much the same, but just wanted to call out that even though Arrive controls when to sell the property, there will be an option to exit the investment early, and we're working on other liquidity options, such as a secondary market that we're hoping to launch over the next few years.
Awesome. Prem said that's awesome. So thanks for walking through it, Jake. Two notes there. Our hold time for long-term rentals is between 5 to 7 years. For vacation rentals, we're aiming for 5 to 15 years. While we do recommend those holds, as real estate is traditionally one that you stay in longer, the goal with liquidity in our redemption program is so you have access to your money across the board. So more to come in that space, which Jake had touched on. We'll be sure to share more. I saw another one flow in here. Does Arrive have direct connection with TurboTax to pull the data electronically? Jake, I'm going to kick that one over to you.
We don't have the auto connection yet, although it's something that's definitely on our roadmap. The good news is that TurboTax has a really, really, really great PDF drag and drop feature. So I did my tax return on TurboTax last year, and it's a 15-second process of downloading your Arrive 1099 as a PDF and then just drag and drop it onto TurboTax. And then TurboTax just electronically reads the form, picks up the information, and you just have to do a quick verification to make sure everything looks correct. So we don't have that auto integration yet where it just automatically zaps it, something that we're working on. But in the meantime, it's really, really easy to file.
Definitely. Yeah, great feedback. I will say too, webinars are one of our main source of where we gather feedback as we're building Forum Bayou. So if it's a market you would like to see, an asset class, something different within the platform, definitely let us know within the chat. We are here for it, and it goes directly back to our team. I saw another one from Vishant. Any plan for daily or monthly dividend or dividend reinvestment? Jake, this is near and dear. I'll kick this one over to you.
Yeah, we are working on it. So right now that rental income is basically tallied up each quarter and then distributed out to the investors. And we're working on speeding that up to be monthly. So I think that's definitely something that we're focused on now and expect to see that come out in 2023. It'll be really exciting to get those monthly deposits of your cash flow into your bank accounts.
Wonderful. Yeah, I would love if you have feedback too on Vishant, like what you would like to see. I'm curious, like if you see value in those daily updates, weekly updates, monthly, how that impacts your investment experience. We'd definitely love to learn from you as an investor. I saw this one flow in from Tom. And Joel, I'm going to kick this one over to you. If I purchase on Arrived Homes 12 months ago, but the property has been held by Arrived for over 4 years, while I pay taxes on the gain over the 4 years or the last year.
Right. Well, it'll be based on the entire time it's held. The property's been held, so it's not just the last year. However, if you're buying a property that's been in existence for 4 years, the share price is going to be whatever the current price is. So if it's appreciated over that time, you have bought in at a higher price, so your gain is going to be less. So it should just work out to be that you pay the gains on the amount of time that you've held the property, and all of that should be factored into the share price that you pay when you do buy shares of an existing investment versus buying them at the very beginning where it's all the same.
Definitely. Greg, I saw you. Is there any plan to allow dividend reinvestment moving forward? It's something we're definitely considering, as Jake just mentioned. So appreciate the feedback there. I did see one flow in from Benjamin, and we did chat about this briefly in prepared remarks, but I do think it's good to cover. Would you mind talking about our ability to take advantage of bonus depreciation? Joel, I'm going to kick that one over to you.
Sure. So, technically REITs can get bonus depreciation. And what this means is there's some, you could do some advanced accounting on a house, and you could divide the house into the structure and the contents, let's just say for simplicity, and the contents you're allowed to depreciate faster, which could drive a tax loss. Now, as it happens, even without doing that, our depreciation is wiping out a good chunk, if not all, of our income. So spending the time and money on the accounting work to get a bigger loss wouldn't do anyone any good. Also, as we talked about, REITs are not allowed to pass on losses to investors. They get to keep them and carry them forward to future years. So it really wouldn't do, within our model here of buying these, with these single asset REITs, it really wouldn't accomplish anything. But if someone owned a big apartment building on their own and had, kind of their own, some other things to offset, that's when that kind of bonus depreciation could come into play.
Wonderful. And there's another one following this one from Christopher. Joel, how is the appreciation return reported in our portfolio? How is that determined?
I'll let Jake answer this one because it relates to our share prices.
Sorry, we're talking about the appreciation of the shares.
Yeah, how is the appreciation determined in our portfolio?
Yeah, so each basically, for the first 6 months after a property launches on the site, we just kind of let it start its normal operations. After that initial 6 months, we start revaluing it each quarter. And the process is basically, our investments team goes out and looks at the value of the property, the actual real estate, and compares it to, the comps in the area, looks at some of the, automated valuation services and comes up with a value for the property. And then we combine that with the value of the LLC. So that LLC has other assets and liabilities. It's got cash that's sitting in its bank account. It's got, prepaid insurance. It might have taxes that are due. And so we combine those to come up with a value for, what is the value of the investor equity today? Now, of course, it's just an estimate. So that amount that's in your portfolio, may go up and down during the time horizon because so much is dependent on, what is the value of that property. And you only really know the value of the property for sure when you actually go to sell it. And since we aren't going to sell for several years, we're kind of taking our best estimate for what that property is worth and therefore what those shares are worth. So even though you'll see the, appreciation value in your portfolio go up and down, remember that is the unrealized gain. So you won't actually owe any taxes for the appreciation until the end of the investment, whether that's you selling your shares or Arrived selling the property itself. It's more of an informational way for you to kind of track the performance of the property. There aren't any kind of tax implications specifically of that appreciation component until the end.
Wonderful. Yeah, thanks for walking through it, Jake. We're getting close to the end of our questions. So if we miss them for whatever reason, definitely let us know in the chat. James or Nancy, I just saw one. Do we get multiple 1099s for each property or consolidated? Oh, Jim, this is consolidated, just so you're aware. We do have one that I saw flow in here from Martin, and it was around, let me scroll back up here. I just missed it. I think it was about reassigning a 1099 to an existing S Corp. Joel, I'm going to throw that one over to you.
Sure. So this just has to do with how you're holding title to your Arrived investments. So when you sign up and invest, you're either doing it on your personal account or through an LLC or an S Corp or an IRA. And if it's something that you, for some reason, had to change down the road, then you'd have to contact our investor relations group to talk about that process.
Yeah, it's a great question. Essentially, once you have invested or made investments, created that account, we're unable to change it, but you can create a separate account. So as Joel just mentioned, if you run into that, definitely ping us support@arrivedhomes.com, where there's a little chat widget in the bottom right-hand corner where you can help us. So Martin, definitely keep us posted there. I saw another one flow in here from Tom. Senior housing and low-income housing has some great tax incentives and or grants available. Has Arrived Homes thought about trying any of these possible investments for a better investment return? Joel, would love your thoughts.
Yeah, it's definitely on the table for the future. The complexity level of dealing with both senior housing and low-income housing is extremely high. And we would need to partner with the operators that do this daily and be a capital source for them. But They are potentially good investments for sure. They operate very differently, and there's just a lot more to it than kind of where we started with short-term rentals, long-term rentals, and some of the things that we may have next. But eventually our goal is to provide a truly diversified set of offerings to everybody. And see from a demographic point of view, senior housing, the trend lines are very supportive of the need for that type of product. So it's something that's certainly on the table for the future.
Definitely. I'm sure Cameron would love to hear that too. We were talking last week about, I think it was like parking garages, vacant land, all sorts of different asset classes. So definitely appreciate you bringing it to the table, Tom. I do want to mention too, I know there was a mention in here from Patrick about IRAs. We'll definitely chat about that offline with our team and appreciate you sharing that. We're all getting older. That is definitely true, or tripping on our words this morning. So appreciate the question. As Jake mentioned, we are running low, so I'll give it a few more seconds here before we close our virtual doors. If we missed any of your questions, we are human, so definitely let us know in the chat. We would also love to hear, based off the content today, if this was helpful. We built this webinar based off investor feedback because we've spent a lot of our time in our traditional webinars around taxes as a whole. So we would be totally open and to any other that you would like to see in the future as well. So I'm dropping a poll in there if you found it helpful, yes, no. If not, what you would like to see in the future. Would definitely love to see it.
Will also be, if you have other questions on Arrived as a whole and how we operate, I just dropped the link to sign up for our regular webinar series. We'll be having them on Tuesday and Friday this week. And Corinne will not be joining us because she's getting married this Friday. So an early congrats to her and Cody. And if you want to come hear Cam and I, babble around about real estate, we'd love to see you Tuesday, Friday for our regular session on Arrived as a whole, how it works, and how we make investments.
Wonderful. Yeah, thanks so much, Jake. Very excited. And thank you for everybody in the chat. It's blowing up with congrats. So I would definitely appreciate it. The one thing I will say in here, I saw there was a few questions around fees as a whole. We do have a little bit of extra time here. Jake, if you want to walk through the two fees that we have, and then for those on the line, we can always take this offline too and answer any clarifying via support@arrivedhomes.com.
Yeah, so Arrive basically charges two fees to the investors. There's an upfront sourcing fee, which is baked into how much money we need to raise for the property. And then there's an annual assets under management fee. And I saw John just drops the link in the chat. The fees vary depending on if it's a long-term rental property or the short-term rental property, those vacation rentals, just because the vacation rental properties take a lot more energy to be renting out to new folks, multiple times a month instead of once every year or two. The fees are a little bit higher on the vacation rentals. So there's a breakout on that specific FAQ on our page. But basically, yeah, there's an upfront fee, and it's baked into what we're raising. So when we go to raise money, it's for the property, it's for the improvements, it's for the cash reserve, and it's for the Arrived upfront fee. It's already included in the investment. So it's not like you get to the end and get hit with a taxes and fees kind of section on your investment. And then after that, it's just that annual assets under management fee. And what's really cool is that is taken out of the rental income that the property generates. So you don't have to pay Arrived more each year. Once you make your investment, that's kind of it. We'll take that fee directly out of the rental income. And the other great part as it relates to this is that it's an expense. So that assets under management fee is essentially tax deductible to investors because it helps reduce the profit on those properties and therefore make it so that there is less taxable income and less taxes that you'll need to pay. So that's a good little twist on a question that we get often.
I definitely appreciate it. Deb and Scott, if you have any further questions around fees, definitely let us know. We also, like Jake mentioned, have a webinar tomorrow, our standard one-on-one, 101 on Arrived as a whole, and then one on Friday. I will plug too, we will have our Q3 financials webinar coming up early next month. So stay tuned in your email. We'll have more details there on that coming up soon. Jake and Joel, any closing remarks before we shut our virtual doors for the day?
Just excited. We have hundreds of people interested in tax.
Thanks for joining, folks. Lots of fun talking, taxes in the weeds with you, and excited to be investing with you.
Wonderful. Well, Joel and Jake, thank you so much for your time today. John, thank you for crushing it in the chat. We appreciate you. For everybody on the line, thank you for an engaged chat. It makes this so much more fun, and for the feedback around this webinar as a whole. So again, you'll catch Jake and Cameron and John Tuesday and Friday, and we will see you all later. Have a good day.
See you guys.
Bye, all.